All right, today we're diving into a really dangerous disconnect that's happening right now in the global oil market. It's a story about high-stakes geopolitics, a hidden trap for investors, and it all revolves around the world's single most critical choke point for energy. Let's get into it.
So here's the central puzzle, right? The financial markets are basically betting on peace. They're seeing headlines about ceasefires, about diplomacy, and they're optimistic. But in the real, physical world, the ships, the actual tankers carrying the lifeblood of our economy, they're basically at a standstill. So how can both of those things possibly be true at the exact same time?
And this number, this is why it all matters so much. 20%. 1/5 of the entire planet's daily oil supply has to squeeze through one narrow waterway, the Strait of Hormuz. We're not talking about a small hiccup here. We're talking about a potential catastrophic shutdown of the global economy's jugular vein.
To really wrap your head around what's happening, you have to understand that there are two completely different stories being told. The first story is all about diplomacy, played out for the news cameras. The second story? That's the grim reality playing out on the water, far, far away from any headline.
So here's what the financial markets see, right? The White House sends some envoys to mediate talks, an indefinite ceasefire gets announced, headlines flash, trading algorithms go nuts, and the market immediately prices in all that good news. This is what we call the paper market. It's trading on the hope of a deal, not the reality of physical oil.
And this just perfectly illustrates the disconnect. While traders in New York and London are betting on a peace deal, the IRGC has, for all intents and purposes, maintained a blockade of the Strait. You see, shipping insurance has gotten so ridiculously expensive, it's like trying to insure a building that's already on fire, that passage has become economically impossible. The actual physical flow of oil has slowed to a trickle. The diplomatic show has no audience out there on the water.
So, this brings us to the very heart of the mispricing. The oil market is speaking two different languages right now. You've got the language of paper futures contracts, and then you have the language of the physical supply chain. And believe me, they are telling two completely different stories.
The physical market is screaming one word, and that word is backwardation. Now, I know it sounds technical, but what it really means is just one thing: panic. Think of it like this. Imagine you're in a desert. The price for the very last bottle of water available right now is going to be incredibly high, right? That's the spot price. But the price for a guaranteed case of water to be delivered next month? Much, much lower. Backwardation is when refiners are so desperate for oil today that they are willing to pay that insane premium for immediate delivery. It is the clearest possible signal of a severe, urgent shortage.
And this table just lays out the two realities perfectly. So normally the market is in what we call contango. There's plenty of oil, inventories are high, so future prices are a little bit higher to cover the cost of storing it. It's a market of abundance. But today we're in backwardation, a market of scarcity, where the price for oil right now is way higher and it's signaling pure panic. Now for traders, this is a huge deal. In a normal market, rolling futures contracts cost you money. But in this crisis market we're in, it actually pays you to bet on the current shortage.
And look, here are the numbers that show you just how massive this gap is. The paper price, what you see on the news, might be, say, $105 a barrel. That's driven by all those diplomatic hopes. But the physical price, what a refinery in Asia actually has to pay to get a real tanker of oil delivered, has been as high as $141. That's not a gap. That's a completely different reality. One price is based on hope. The other is based on the desperate, real-world scramble for supply.
Now this gap between paper and physical reality, it doesn't just confuse the market, it creates a hidden and frankly brutal trap for investors. Anyone looking at the headlines thinking, hey, maybe I should invest in oil? Well, they're probably walking right into it.
And here it is. The brutal truth is that an estimated 90% of retail money that flows into oil goes into products that are almost structurally designed to lose money over the long haul, even if the price of oil goes up. It's a trap. And it's built on a fundamental misunderstanding of how these things actually work. So the trap is this mechanism called roll yield decay. See, popular oil ETFs don't actually hold physical barrels of oil. They hold futures contracts. And in a normal contango market, every month they are forced to sell the cheaper expiring contract and buy the more expensive new one. This constant selling low and buying high acts like a silent tax that just bleeds value from the fund month after month after month.
And this chart, wow, it shows the absolutely devastating result. Over the last 10 years, you can see this massive gap between the actual price performance of spot oil and the performance of an ETF like USO. So while oil itself might have rallied, the fund has consistently underperformed because of that relentless roll yield decay.
It's a mathematical certainty of value erosion that just catches so many people completely by surprise.
Okay, so we've looked at the diplomatic theater, the physical reality, and the trap for investors. But what happens if this whole situation gets worse? I mean, what if the functional blockade becomes a total, undeniable closure? Let's walk through the nightmare scenario.
This is the question that keeps economists and world leaders up at night. And we're not talking about a month-long war or anything like that. The global energy system is so finely balanced, there's so little slack in the system, that a complete closure for just 2 days could trigger an economic shock like we've never seen before. And here's why the impact would just be exponential. First, you instantly lose 20 million barrels a day from the market. Gone. Second, strategic reserves. Yeah, they're big, but they have infrastructure bottlenecks. You physically cannot pump the oil out fast enough to cover that kind of loss. And third, even the oil you can get out is often the wrong type. It's a different grade of crude than what many huge Asian refineries are built to process, which creates even more delays and even more panic.
So the timeline for chaos is terrifyingly fast. Within a single week, paper prices would surge up to 50% just on sheer uncertainty. Within a month, the physical price for any oil you could actually get your hands on would skyrocket towards $200 a barrel as refineries just bid against each other for survival. And within 3 months, those high energy costs would absolutely cripple major economies in Asia and Europe, tipping the entire world into a deep, deep recession.
And that brings us to the panic threshold. According to analysts, a total 48-hour closure would cause oil prices to hit $150 a barrel almost instantaneously. This isn't a gradual climb, it's a shockwave. It's the price at which global demand starts to get destroyed on a massive scale, simply because the economy cannot function anymore.
And that leaves us with this final, really unsettling question. I mean, we live in an age of high-frequency trading and instant global news, right? Yet the financial market for the single most important commodity on Earth has become dangerously detached from the physical world. It's a system where the hope of a single tweet can actually outweigh the reality of a physical blockade, creating a mispricing so enormous it genuinely threatens to trigger the next global economic reset.